a Main Street Asset Management CIO. Aaron, on this, view that more Washington spending, that this is just the latest wrinkle, the loan forgiveness, but there's the Inflation Reduction Act, there's the CHIP measure. That's a lot of planned federal initiatives. What do you make of it?
No, I do. I think, we've already been able to somewhat measure the impact of the American Rescue Plan from COVID. And that basically created, it's estimated, but between 2 and 4% of inflation came from that act. Now, when you start adding up all these additional acts, again, very big estimates, but we're still estimating between 1 and 2% of inflationary pressure, when all we're trying to do is fight it and get it back down.
Right.
So
does it complicate what Jerome Powell wants to do?
I think absolutely, because
so if he was thinking of a half-point cut, does he pre-move and make it a three-quarter-point cut?
I think no. I think the Fed ultimately is, they love to say data dependent. They're just going to wait for it to happen and then react.
Because these type of responses are very delayed when it comes to federal spending, but
exactly.
That's just another wrinkle in the future.
So, and this ultimately means that we're probably going to see rate hikes further into next year, rather than what Wall Street was hoping initially of even cutting rates, sometime in the second half of next year.
That is off the table, as far as you see it.
Yeah, so like once these plans have gone through, for me, that says we're not going to see rate hikes for next year, because we have so much money coming in next year through federal programs.
What does next year look like to you then, economically? I mean, some people say a recession, others argue we already have the classic definition of recession, but I mean something that picks up considerable steam southward. That is the layout for next year. Do you buy that? Yeah,
I think, we certainly, I could see recession going into the second half of this year. Absolutely. I mean, technically, it looks like we're going to be contracting. I'm not sure really just how strong from an economic standpoint we're going to be when it comes to just how far they're going to let unemployment go, if that's really going to be able to rise. What I am worried about from a corporate sense and from an investing sense is that we're really looking at very low profit growth for next year. We're looking at about 5%. Now,
really?
5% profit growth.
That means even with the kind of sell-off we've been seeing the last few days, that could add some speed.
And it,
do you see that?
Consistently also below inflationary levels. Like, they're not even increasing profits at the rate of inflation.
So in real money, they're not making money.
So, that certainly can put some pressure on valuations.
Even at these levels. In other words, a lot of people look, what happened over the last 3 days? My God, 1,600 points of the Dow, and this big slide we've been seeing, that's going too far. If you're right, it isn't.
And I think, that's what Wall Street, right now Wall Street is just sort of looking at the 10-year and following that. They're very highly correlated. But certainly right now we're looking at valuations that are only at the same level of 2019. So we're at the same, and
is
obviously,
that right?
Yeah, we're at 17 and a half.
That was considered rich then. Is it rich now?
I'd still say it's a little rich, because in 2019.
What's a little? 5%, 10%?
5%.
Really?
We would just have to go down 5%. We'd be closer to fair value, and looking in an environment with raising interest rates. We could still, if profit growth could really grow, but that's all about, are we going to pull back this economy so much that profits come down even further? Look, analysts are known to be incorrect. They're known.
Not you. Aaron, I will say, if you're right on that, and we're getting hints of it with these, the latest ADP private sector, half what people thought it would be. Even companies like HP hinting that business demand isn't there following, tepid consumer demand. So layoffs and that sort of thing, beyond what just Snap did, but, getting rid of 20% of its workers, that we could start hearing more of that.
Yeah, I think we could, because ultimately, when we finally see that consumer slow down, just as if mortgage rates go up, you've got bigger payments that you've got to do. Spending comes less, companies have to pull back. So I am certainly worried about what's going to happen next year, and just, how companies are going to be able to navigate these higher interest rates and then compounding the inflationary pressure with a lot of these programs.
So real quickly, a lot of people seek you out for investment advice, as they should. You're very good at this. Young person comes up to you, says, I know it's been crazy, but I want in. I want to get into this market. What do you tell them?
Actually, at this point, I feel pretty safe. Even if we see, a 5%, even 10% down from here, it's relatively a safer place to get in right now.
Particularly for a younger person.
For a younger person. Now, if you need the cash for the next 6 months, keep it in cash. But if you don't need that cash for the next 5 years, trying to time the exact bottom is
Right.
really tough. I think we're pretty darn close to it. If not, we've already seen it. We might just sort of stay flat, which is still more than you're going to earn in a lot of your, just simple bank accounts. And this is a
Well, by
great
the way,
time
you
to
mentioned those
invest.
simple bank. I'm sorry to go over here, guys, but you mentioned that CD rates are seeing tiered CD rates 1, 2, 3% over X years. That's a little bit of competition for stocks, isn't it? Considering
Not
that people have
much.
been losing a lot of money, right? It's all about protecting what you have.
Yes. So those are if you need the cash in the next year,
Right.
absolutely, that's where to go. But if you're ready to look a little farther ahead, this is actually looking a little safer place to get in. So I'd say
Okay.
go for it.
Very nicely finessed. Erin Gibbs on all of that. Corner World brought that out.